Hey friends, very good morning. Welcome to another interesting video of FxYogi. In today's video, let's learn about the 5 deadly O's of trading. What traders do to guarantee their own failure. Part 1. Did you know that the 5 deadliest factors that cause traders to fail are self-inflicted? Many traders self sabotage their own trading and may not even be aware they are doing it. When their account goes to zero, they have nobody to blame but themselves. While it might be too late for these traders, fortunately, it's not too late for you. We want to make sure that you don't suffer from the same blind spots and can hopefully avoid sharing the same fate of a blown account. To make it easier to remember, we call these negative factors the O's of trading, and there are 5 of them. So, what are the 5 O's? Number 1, overconfidence. 2, overtrading. 3, overleveraging. 4, overexposure. And 5, overriding stop losses. Let's take a look at each O more closely. Overconfidence. Overconfidence isn't simply the feeling that you can handle anything. Overconfidence is characterized by an inflated belief in one's own trading skills. Confidence is critical in becoming a successful trader. When you're confident, you're more likely to take risks or look for opportunities. However, it's one thing to believe that your trades can potentially be profitable, but it's another thing to think that you know everything about the markets and that there is no way for you to ever lose because all you do is win. While confidence is necessary, too much confidence can have negative consequences. This phenomenon is known as the overconfidence effect. The overconfidence effect is a cognitive bias in which someone believes subjectively that his or her judgment is better or more reliable than it objectively is. Basically, when your confidence is high, your opinion of yourself is higher than what an impartial or rational person who is not your mom would think about you given the same set of facts. Psychologists observe overconfidence in 3 distinct forms: overestimation, overprecision, and overplacement. Overestimation is a tendency to overestimate one's performance. Overprecision is the excessive confidence that one knows the truth. Overplacement is a judgment of your performance compared to another. Said differently, overconfident flocks believe they are better than most and overestimate the precision of their knowledge and the level of their abilities. For example, if you ask a bunch of random people to hate their own driving abilities, you will find that most people consider themselves to be above average drivers. If everyone is an above average driver, where are the average drivers? To minimize the effects of the overconfidence effect, you must take time to truly understand yourself and what you are capable of achieving. You must be aware of your limitations and what opportunities are not worth pursuing. Most importantly, you must always consider the possibility that you are wrong, to listen to new evidence and to know when to change your mind. You must have the confidence to trade, but this must be balanced with intellectual humility. Overtrading, including revenge trading. Overtrading is when you are trading too frequently, taking extremely large trades and or taking uncalculated risks. Successful traders are extremely patient. Quality setups take time to materialize, so they remain patient and wait for confirmation. It doesn't matter if the setup takes 2 hours or 2 weeks to take shape. What matters is protecting their capital, so they will wait until the odds are more in their favor before entering. You will know if you are overtrading. If you close a trade for a loss, and deep down you feel like you shouldn't have taken the trade, then you're guilty of overtrading. For example, when you're supposed to trade from the daily chart, do you find yourself still looking at the lower time frame like the 5-minute chart and discovering better trades there? Do you find yourself spending hours staring at charts and trying to force a trade with good enough setup? Spending too much time staring at charts tends to cause overtrading because you become prone to falling into a trance, looking at so much price action and indicators that magical setups will just start appearing, which are actually just mirages. Revenge trading. Letting your emotions get to you regarding your trading performance is dangerous. When it comes to trading, the head, not heart, should be in charge. When you suffer a large loss or a series of losses within a short span of time, you might be tempted to revenge trade. You want to get back at the market. Revenge trading is when you jump back into a new trade right after taking a loss because you believe that you can quickly flip the loss back into a profit. When you start thinking like this, your state of mind is not objective anymore. You become more prone to making even more trading mistakes, which results in you losing even more money. How do you avoid revenge trading? Be fully present and fully focused while trading. Make sure you are in a good state of mind and not currently filled with negative emotions such as anxiety, apathy, fear, greed, or impatience. Have a trading plan and stick to it. Always trade in a methodical manner. There is no place for random improvisation when you enter or are in a trade. If you want to succeed as a trader, you must think long term. Don't stress over one loss or even losing a couple of days in a row. Stay focused on your trading performance over the coming months and years. It's easy to think that the more you trade, the more money you will make. But the opposite is true. Trading is a game of patience. Traders who wait for quality setups and sit on their hands in between are the ones who will end up profitable in the long run. Focus on the process, not on the profits. That's all for today. Let's catch up in part 2 tomorrow. Until then, take care. Bye bye.